gotta leave your money behind.
Hello, everyone. This is Syl Michelin with Wagner Condon Financial Advisors. Thank you for joining. I'm here today with Stan Farmer, and we're going to discuss a very timely topic this time of the year, tax loss harvesting. And specifically, we're going to ask ourselves, should U.S. expats do tax loss harvesting? And if so, how? So
also a very timely topic because in terms of the market cycle, we're hopefully at peak harvest.
Yeah, this
when it comes to losses.
Hopefully. So Stan, just to get us started here, do you want to tell us first, what is tax loss harvesting?
Right. So, in taxable accounts, so let's make this really clear, like in a brokerage account that is not a tax-deferred or tax-free retirement account, but in a regular, straight-up brokerage account, a capital account, as it would also be referred to, because capital gains rules apply. When you're not taxed on the appreciation of your account. This is U.S. tax law and tax law in most foreign countries, not all of them. You're not taxed on the appreciation of your account. You're taxed at the time of realizing gains, right? So if you sell a bunch of different securities in your account over the course of a normal year, you might have some that you sold that were gains, and some of them had depreciated in value, and you got rid of them in frustration, and those are the losses, right? And gains can generally be offset against losses, and that tends to be true in most jurisdictions where capital gains type rules apply for brokerage accounts as opposed to taxing the appreciation. So tax loss harvesting is simply a tool where you don't necessarily want to dramatically change your portfolio, but for tax reasons, you would like to take losses in positions. And this tends to be most beneficial when you have earlier in the year realized significant gains, right? That's when it's the most effective. If you haven't realized gains and you just go willy-nilly selling all your losses, you generally get to carry them forward and you get to offset $3,000 of your ordinary income, like your earned income, your retirement distributions, your Social Security, et cetera. But, by and large, it's all about picking up a bunch of losses at the end of the year to relieve you of the tax burden of gains that you otherwise have realized during the year.
Okay. So in practice, it just means selling investments that are trading at a loss in order to realize that loss and be able to record it for tax purposes.
Right. And the way that this is normally achieved or most elegantly achieved, we have what we call the wash law, the wash sale rules in the United States, and this is somewhat unique, right? So we have rules that say that if you do harvest that loss, you cannot buy that security in any account within a 30-day window, in front of or behind it. So like you can't buy it in your Roth IRA and then sell it at a loss in your brokerage account the next day. You have to wait 30. It can't fall into that 60-day window in front of or behind, or after, before or after. So how do you achieve that without like materially changing your exposure? Like if you want to be a market participant, you want to maximize your time in the market rather than time the market. Right. And the wash sale rules, you think, well, geez, this is kind of like forcing me to time the market in a sense, right?
Right.
So I'll give it to you. How do we achieve this without materially changing the underlying portfolio?
Yeah, well, look, the way that this is commonly done is basically selling one position and then buying something else that is substantially, similar, but not identical, right? So the rules in the US are actually very well defined, and basically as long as you buy something that, for example, if it's a fund, as long as the fund doesn't track the same index, then effectively you're fine. So tax loss harvesting is really it's really common practice in the US. It's very standardized. The rules are very clear, and it's something that we all do in our investment practices. And basically, the way it works is typically this time of the year, we look at accounts. If we see positions trading at losses that can easily be replaced by something similar, you will realize that loss by selling the position, reinvest in something comparable, right? So you maintain a similar underlying exposure, but at least you get to record that loss. And so, if you sell a position that was at a $10,000 loss, then you get to record that loss on your tax return. And if you had a gain prior in the year, then that gain is reduced by $10,000. And like you said earlier, if you didn't have a gain, it doesn't matter, because you can still use that loss in two ways. You can use $3,000 worth of that loss to offset income, like your salary, for example. And if you still have a loss, in this case, you still have $7,000 worth of loss, you get to roll that over into next year. And if you don't use it next year, you get to roll it over into the year after. So
Right.
it never expires. So it's beautiful. It works great. And everybody, tries to take advantage of it and be smart about it.
Domestically.
Domestically.
It works. It's tried and true, and every advisor and many home gamers do it without with the greatest of ease.
Now, does it work for expats, and does it work, in an international context? It depends. It's complicated is really the answer, I think.
And fundamentally, like kind of, for those who may not be expats at this point, but maybe contemplating a move abroad, or newbie expats that haven't really gone through the tax process. Mm-hmm. Fundamentally, at the core of things, what makes it complicated, Syl?
Well, so, there's a few things. So, number one, you need to ask yourself. So, say you're an expat and you live in a foreign country. Say you live in Europe somewhere. So, the first thing you need to ask yourself is, what actually constitutes a gain or a loss, a capital gain or capital loss, and how is it calculated? And what I mean by that is, you can look at your brokerage statement and see a position that's trading at a loss. So that calculation is based on the US dollar value of that particular position.
And your US cost basis.
And your US cost basis. Now, how does your local accountant report that loss if you realize it, right? If they actually take currencies into consideration, then what you're looking at in terms of, dollar performance, you could be looking at a US dollar loss, for example, may actually be a much larger loss when calculated in a different currency, or may actually be a smaller loss. It may actually be a gain. And the reason for that is that, if you properly calculate investment gains and losses in foreign currencies, the way to do it is you need to look at in this case, let's say the euro dollar conversion rate at the time when you purchase the security. So you take the purchase price of the security, multiply it by the conversion rate on that date,
right,
when you purchased it.
So for that investor in Europe, they're going back to a time when they acquired the asset, and it may be before they even lived abroad.
Absolutely.
And they're converting that purchase price into euros based upon the historical exchange rate on the date of purchase.
Correct. Now, you have to do the same thing on the sale side. So when you sell the position, there's the sale price in dollars, and then you multiply that value by the euro dollar conversion rate on the day of the sale. So what you now have is, a calculation that can look very, very different, because you don't just look at the dollar performance, but you combine it with the currency performance. So, simply put, the euro is probably down about 10% against the dollar so far this year. If you have a position that is down 10% in US dollars and you bought it earlier in the year, you're probably flat in euros. Right. So what you're realizing in terms of a loss in dollars may not actually be a loss in euro terms.
Right. So let's assume for a moment that for this client in somewhere Europe, I'm not sure. I haven't looked up the tax treaty provisions or the tax rates for somewhere. But let's assume for a minute that the tax rates on capital gains for the client would be 15% based on the way U.S. capital gains are applied. You can be in the 0, 10, or 15. No, I'm sorry, 0, 15, or 20 tax bracket. Let's assume that the way capital gains are taxed, it could be called capital gains, it could be called portfolio income or investment tax, whatever. But let's assume that it's 30% in the European country.
Right.
What benefit does the taxpayer get from taking the loss in dollars if you're flat in euros?
The loss in dollars in itself, it never hurts, in the sense that the US will always let you carry it forward.
Right.
So it doesn't work. Now the risk, though, is, what if it's actually a gain in euros?
Right.
Then you start getting into a situation where you may have caused yourself to actually, bring forward a bunch of gains that you could have deferred, just because you're not really properly accounting for the gains and losses.
I mean, no question. That's the easy answer. I mean, like, if you have a gain in euros, then it's obviously not attractive.
Right.
But even if you're flat, I might opine that if you live in a higher tax jurisdiction, you're effectively a taxpayer in that jurisdiction.
Sure.
You're using the taxes that you pay in that foreign jurisdiction to basically eliminate your U.S. tax liabilities altogether, by and large.
Right.
Right?
Absolutely.
So, I mean, so maybe, you go in there thinking that you're doing some good in the world, but if you're uninitiated in the procedures by which to calculate gains and losses in a foreign currency,
right,
you may think that you're doing some good, but ultimately it could be detrimental, or it could just not be effective.
Right. Absolutely. I mean, there's no point reducing your U.S. tax liability when you don't owe any U.S. taxes, right? Because in a cross-border context, all that achieves is really increased, unused foreign tax credits, which, in itself has its own kind of complexities associated with it.
Now, one interesting thing I find out there in the real world, working with clients all over the place, right? Many countries in Europe, many countries in Asia, countries in South America, other countries in North America, for that matter. But working with countries in various jurisdictions, obviously, as residents of those countries, they're tax residents of those countries, and then they're tax residents of the United States. So they're working with, like the on the U.S. side, when, I generally recommend to clients that they work with an expert, accountant, in terms of familiarity with special things you need to know about expats, like foreign tax credits, right? Mm-hmm. Well, I mean, on the other side, right, they're paying taxes somewhere else, and oftentimes it's even more vital that they get professional help in the other country because, well, for one thing, most expats are less familiar with the tax laws of the country that they live in
right,
than they are with the laws of the United States, because they've been dealing with taxes since they were probably, 19 years old, right? So one thing, that you have to think about is that, there's, literally, a cottage industry of U.S. expat tax preparers, but when they're going to their local tax preparers, I mean, there's probably a million of them out there in the world, right?
Right.
And they all have different, levels of experience when dealing with people that hold overseas assets. From their point of view, your U.S. brokerage account is an overseas asset, right? And when I talk to so when I start thinking about tax loss harvesting, the first thing I want to know, I know what is usually the most appropriate way. And I know that, from experience, I've been told with great conviction that, Germany's stickler for this, right? The UK, the HMRC lays out rules for this, and this is the way that it should be done, the way that Syl described it, right? Where you're factoring in the currency. Another way that it could be done, and it's what we'll call it the lazy method, or just the, I didn't think about this as clear, I didn't think of the whole picture here method, is to take a client's 1099, look at their U.S. gains and losses, and convert them based upon, the end of the year or average for the year currency conversion rate, and just take their U.S. gain and euroize it, so to speak, based upon just what the U.S. gain was.
Absolutely, and that's a very important exception to what I mentioned earlier. Is it all hinges on how is your accountant going to calculate the gains,
right,
as I mentioned. And it's true that some accountants will just take your 1099 and look at the conversion rate on whatever date it is that they're doing the work and make the conversion. And if that's the case, then that makes things a lot easier in terms of thinking about tax loss harvesting, because effectively it means you can think about it in the same way as you would in US dollars, right?
Yes.
So now
our analysis of how to tax loss harvest is simplified by this lazy method.
Yeah.
But
and look,
it may not necessarily be the right way to do it, but it is ultimately, at the end of the day, it's what the accountant's going to record
we
on
always
their
defer
taxes.
to what your accountant will be saying.
Right.
But let's be clear, like there are countries like in Germany, for example, as you mentioned, the rules are very clear, right? You have to take the average conversion rate of that particular date. You actually are supposed to look at the specific rates that are published by the German central bank, and that's what you have to use, right? So if your accountant uses the 1099 and just does a sort of back of the envelope calculation based on that, that's technically incorrect, right? I mean,
technically,
so you have to be a bit careful. So there's a way to do it by the book, and there's kind of a back of the envelope way of doing it. And in some countries, the back of the envelope way of doing it may be perfectly fine, but in others, it might not.
I had a client for example, I had a client in Japan that long-term Japanese resident, married to Japanese wife, and he considered her to be his bookkeeper, and says that he'd try to do his own Japanese. A lot of foreign tax returns aren't as complicated as the U.S., by the way.
Right.
So there's this tendency and inclination to want to do it yourself sometimes if you're if you're really entrenched and fluent in everything, and you can follow along.
Mm-hmm.
So I'm talking to him because there's what I see as potential tax loss harvesting. But I want to know, how's he gonna recognize the gains and losses? And he actually talked to somebody in the tax authority, right? And they said, "Well, how have you been doing it?" And he said, "Well, I've just been going on, because I told him the way that it probably should be done,
Right?"
And it's but he's like, "I wasn't doing it that way," and I'm like, "Well, see, talk to somebody there," and he did. And the reaction of the agent was, well, it's more important to be consistent than to be right. So continue to do it the way you've been doing it. It could be that
as long as you apply it consistently, either methods will work, right? So as I said earlier, it depends, and it's complicated. Now, here's another thing that makes it also complicated. Going back to this idea of the cost basis. What is your cost basis, right? So there are countries around the world where you may find yourself in situations where you have one cost basis in the US and a different cost basis in the country in which you reside. Off the top of my head, I can only think of two countries, Canada and Australia. Would be examples of countries that when you move there, you get a step up or down in basis. You effectively update the purchase price for the date of your arrival. So that could be another scenario where, trying to make an assessment of what a gain or a loss would be for the purposes of tax loss harvesting would get even more complicated, right? So again, it goes back to this idea of, okay, I can make a very easy assessment of what my cost basis is in dollars and what the consequences of selling some positions at a loss would be. But what does that actually mean in my country of residence? That's what it ultimately comes down to.
Right. And that's a really interesting one, Syl. I know that that at one time and for a long time, that was the way it was done in the UK as well, that you actually got a basis based upon the fair market value of the asset at the time you become a resident, right? And, that complicates things greatly, which is probably why ultimately tax authorities got away from that notion, right? Because the taxpayers' financial services custodian or whatever that's record keeping for them isn't keeping that type of basis information.
Yeah.
Right?
It gets very tricky.
It almost gets impossible to calculate gains or losses if, you have to go back and recreate what your positions were on that day.
Yeah. Yeah. You have to have very good record keeping. Now, so here's yet another area that adds complexity to your tax loss harvesting strategy as an expat. Well, so there's two other areas I think we should mention. So told you it does get complicated. So one would be what we mentioned as being the wash sale rule in the US, which is this idea that you can't just sell Apple shares at a loss and then buy them right back after having realized the loss and try to record that on your tax return. Because effectively that loss is going to be disallowed, right?
Right.
So you can't just buy something identical. But say you owned a fund that invests in the S&P 500. If you then turned around and you sell it at a loss, and then you turn around and buy a fund that tracks a slightly broader U.S. equity index, then you're fine, right? Now, different countries may have different interpretations of that, right? So the wash sale rule is a U.S. rule.
Right. That's true, right?
In the U.S. it's very well defined.
That's true.
I know I've looked into, wash sale rule equivalent in a few countries around the world. And like Australia, for example, is an example of a country where the rules are not as well defined.
Right.
So it's like there's a lot more room for interpretation.
Are you not able to sell an asset and buy it right back and artificially create the loss?
You are not. You have to buy something that is different, except and I think that's pretty universal, but it may not be in every country. But generally there are rules against that. But in the case of Australia, for example, you have to buy something that is different. It's a bit of a gray area to know exactly how different it has to be. So, there are different interpretations of those rules in different countries around the world. So,
there's so many different types of rules that come into play around the world. I'll give you another example. It's kind of fun, right? So you're like, in the U.S., there's short-term gains and long-term capital gains, right? And short-term gains are taxed at ordinary income tax rates, which tend to be higher than the capital gains rates, right? Japan has short-term and long-term rates. But long-term is 5 years, right? So, when we're tax loss harvesting, we're long-term investors for clients, right? So, when the market is so generous as it has been this year of, dropping so much that there's lots of harvesting that could be had, we do that. But the idea is that, we're generally going to hold positions for many, many years. Right. But so the new position that you buy, then if the market rebounds precipitously, and by the way, that's usually how markets do rebound. They don't rebound like slowly.
Yeah.
They generally, if you miss the first part of the rebound, you missed a good part of the rebound. But so the problem with that is you substituted, right? And, you should be happy with that position when you make the substitution decisions. And one of the reasons is because anybody who thinks, 30 days later, we're just automatically going to switch back, isn't being tax efficient necessarily, right? Because you can have a huge short-term gain by the time you get to turn around and buy the original position. So generally that you achieve that through being, happy with you don't do it unless you've got something that you feel is equally investment worthy for the investor. It meets the same need in the portfolio and just as well.
And you can hold it.
Right. But if you're in Japan, I think about this, right? The idea is that every time you buy something, you've created like a 5-year period where you're not going to want to sell it, right?
You're locked in.
So the idea of tax loss harvesting, it becomes way less appealing, I think, because at the very least, you've increased the window at which the money that you're the proceeds that you're harvesting are going to be available for all intensive purposes, right?
Right.
At the same tax rate.
Right. And there's another point that I wanted to mention about that disconnect between different jurisdictions. And that's this idea that in the US, your unused tax losses can be carried forward. So you can have carry forward losses for the rest of your life. That's also not the case everywhere, right? So there are countries around the world where you can only carry forward losses for 1 year. I believe that's the case with Sweden. So you get one chance. So again, that changes things pretty dramatically in terms of, do I really want to realize this loss now? Or does it make more sense to wait until next year because maybe the following year I'm selling an asset or something? So again, you cannot assume that just in the same way as it was with the wash sale limitations. You can't just assume that these same principles apply to your country of residence, right?
Yes,
and really that changes the way that you have to think about tax loss harvesting as an expat. And the reason we wanted to have this discussion today and we felt it was important is because it's such a standardized, and for a lot of asset managers actually do it in a way that's automated. It's like it just happens.
Correct. And I think the world is falling more and more in love with there's a new term. You get to be, I've been a CFP for 7 years now. I've been in the business since I got in the business in 2004. But there's always something new that you can learn, right? And this year's new buzzword is tax alpha.
Tax alpha.
Have you ever heard that before, Syl, or did you ever hear that before this year?
Yeah, I've heard it before.
Right. But now as a marketing pitch for newfangled ways
it's become a lot more visible for sure.
Tax alpha, synthetic indexing and all of that, now is the primary driver of, and I think it's a big wave, and I know they're going to talk about it on another one. So this is a little off topic in a sense, but the point is that tax loss harvesting on the domestic side of this business, which is the largest size of this business, obviously, is all, being tax efficient means also the potential to drive higher after tax returns,
Right.
Not just by not trading, but to drive even better after tax returns by trading, right? By harvesting whenever and however you can.
Right. And doing so based on U.S. rules that, as we discussed, are very clear,
Exactly.
very well defined,
Right.
very systematic, and you just do it. Now,
so it's very easy for them to write software and algorithms and so on that technology can aid that, but like the software's got U.S. rules programmed into it.
And so we often talk to people in the expat community who tell us, well, yeah, I'm working with, my parents' advisor, or they're working with a typical U.S.-centric advisor. And part of their mandate involves, doing the good old U.S. tax loss harvesting, right?
Yes.
And, it's not necessarily bad, if you live in a country with, no capital gains tax, or you live in Dubai, or, you live in Switzerland, it's fine. You can do U.S. tax loss harvesting. But, depending on where you live, there are countries around the world where, doing kind of mindless tax loss harvesting could end up hurting you, right? It could end up, causing you to even realize taxes that you could otherwise have avoided, right? So you need to be extremely careful. And again, as you probably gathered by now, this is it might seem like a basic topic, but it has a way of getting very complicated once you actually start looking at the rules in detail. So, we're not going to kind of solve every possible permutation today, but hopefully the message we got across is that you always, as an expat, need to think about it from both the U.S. perspective, but also ask yourself, what does it actually mean in my country of residence? What is this tax loss something I can actually benefit from?
And have a discussion with your accountant in your local residence, right? Because
Absolutely.
Like Syl and I said, I mean, like, we're surprised by the magnitude of accountants that don't apply the formalities of how this is supposed to be calculated, right? They do the 1099, they convert the currency, and so it's less complicated.
Absolutely.
Right.
Absolutely.
But we would certainly never take a client and just assume that their accountant does it this way. It's something that you ought to know.
Yeah,
right. And
absolutely.
it's a question that they ought to be able to answer very easily.
And it's not a topic, if you meet a new accountant, you're thinking about hiring them, it's not a topic that you'd necessarily think about bringing up, but it's definitely worth getting on the same page in terms of understanding how they will treat your capital gains and losses going forward. And it's also, when we work with our clients, it's also, great information that we need to have so that we avoid surprises. I think that's all we had.
Yeah, I mean,
today.
I would just add, as a practical matter, right? I mean, like we've invested time and effort to give us the tools that more easily allow us to analyze unrealized portfolio gain and loss in foreign currencies.
Yeah. I mean, so that's one of the benefits of working with us. Is,
rather than just tell you, hey, this is really complicated, it's hard, it sucks, and, happy holidays, we're going to, tell you that, like, this can be done, right?
Oh, yeah, we do it all the time, right?
And I think any financial advisor that works with clients abroad, owes that duty to their clients to act in their best interests, and part of that would be, understanding this and doing the extra work that's involved to make it happen, right? To really fully, understand before doing tax loss harvesting, hey, what are we going to sell here, and what's going to be the residence country tax impact, and what's going to be the U.S. tax impact.
Yeah, absolutely. And so that's one of the benefits of working with a firm like ours is we are aware of all of that complexity, and we try to make our clients' lives simpler by
and sometimes their accountants' lives
simpler by accounting for cost basis in different currencies, calculating gains and losses in different currencies. I mean, I myself keep records of different cost basis for clients who are in circumstances where for whatever reason they have one cost basis in one country and a different cost basis in another. So we have many clients with very complex tax tracking situations, I would say. I mean, another example that we've not mentioned, but it's in the same vein as what I mentioned with Australia and Canada, where you get a step up in basis when you move there. There are sometimes differences in the way that cost bases are treated when you inherit assets, right? So in the US, for example, you get a step up in basis when you inherit an asset. There are countries where you don't. So that would be another example of, oh, wow, I've got one cost basis in the US, but my cost basis in Germany is actually completely different. Hello, and how are you going to make good, tax loss harvesting decision when you don't even understand your cost basis in your country of residence? So we help our clients with all of that, and we do a lot of work to keep track of cost basis. So that's one of the many ways that, as part of our broad holistic financial planning, we are able to help expats make better financial decisions. But it's always very case by case. So what I would say in closing is, if you have questions about this, or if you feel like there's maybe some complexity in your situation that you'd like to discuss further with us and see if we may be able to help, reach out to us and we'll be happy to continue the discussion.
Hopefully we can get Dan to get this podcast out right away, because an important year-end piece of advice to people who may have a New Year's resolution to move abroad.
Absolutely.
Would be that, hey, if you're working with an advisor and they're telling you that they're going to do tax loss harvesting over the next 2 weeks, or you're doing it yourself and you're thinking about tax loss harvesting over the next 2 weeks.
Right.
And you're going to move abroad next year, and this harvesting is just going to create a bunch of loss carry forwards for you on your U.S. taxes. May not be a good idea.
Right.
But it'd be a great time to start a conversation with us.
Absolutely.
Losing my voice here.
I think that's a sign for us to wrap it up. So we did a lot of talking. Thank you, Stan. And thank you, everyone, for listening. And we'll see you next time on Give Me Some Truth.
Happy holidays, everyone.
Happy holidays.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.